Why do rich people keep most of their wealth in assets instead of cash? Warren Buffett is a crucial example of this. Although Berkshire Hathaway has a lot of cash right now, he said he would rather invest the cash in productive assets instead. Taking cues from Buffett, we will show you some of the best cheap assets to buy instead of holding cash. By staying tuned and practicing what we tell you, you will be on your way to retiring early. Beyond enough for day-to-day living, cash is a horrible place to keep wealth. Sitting on a shelf, it declines in value via inflation, and in simple savings accounts, it earns a meager sum at best. Meanwhile, assets appreciate and throw off cash earnings. The best use for cash is to buy assets, and rich people typically amass a collection of assets they have built up over time. Unless a person believes asset values will decline, there is absolutely no other reason why cash should not be put into these assets.
Well, the whole idea of investment is to lay out money to get more money back later on, right? And
some of the assets that you can easily be acquired are equities, stocks. Equities represent ownership in a company. Stocks can be volatile, but they have the potential to generate high returns over the long term. However, investing should only be done with the money you allocate to your future, not for paying debt in 3 months or rent next month.
Today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them.
When you buy a stock, you essentially buy a piece of the company. A good investor knows what he is investing in and is interested in learning more about it. If you do not enjoy learning about the companies you invest in, stock investing is not for you. It is also worth noting that investing is a process-driven activity, which means you need to follow a process and repeat it several times. It would help if you dedicated at least an hour a month to go through the investing motion. Fixed income, bonds. Bonds are loans you make to a company or government. In return for your loan, the borrower agrees to pay you interest payments over a set period and then repay the principal amount of the loan at the end of the term. Bonds are generally considered to be less risky than stocks, but they also offer lower potential returns. Bonds come with interest payments known as coupons, doled out at regular intervals. This can be particularly handy for retirees or anyone looking for a consistent flow of income. It's like a reliable roommate who always pays their share of the rent on time. Now, what about taxes? If you hold certain types of municipal bonds, they might be income tax-free at the federal level, and sometimes even state and local taxes can be avoided. It's like finding a loop in a sweater that, when pulled, unravels the whole tax yarn ball. Diversification is another advantage. In the rough seas of the stock market, bonds are sturdy ships that don't toss and turn with each wave. They don't usually move in the same direction as stocks, so bonds might just be your parachute when your equities perform a nosedive. Real estate. Real estate is a physical asset that can generate income or appreciate over time. It can be a very liquid investment, but it can be difficult to sell quickly if you need cash. They are better at the long term, usually have a significant growth rate, and will pay for themselves. This is a genuine retirement plan. The first one might be hard to pull the trigger on, but the rest will be much easier once you have it. Not just to pull the trigger, but to finance them too. Banks love to lend money to investors who already own investment property. Many people will tell you to flip houses for the quicker big bucks and do it with other people's money. They won't tell you that unless you flip 4 to 5 houses a year, you can't make money because of the time invested, labor, and holding costs. Plus, if you don't have the cash to do your flips, you have to use a private investor or hard money lender, and a large percentage of hard money lenders are a lot like loan sharks, which increases your holding costs. Once you start flipping, if you aren't using your cash, you kind of have to keep flipping for the income to keep coming in. Location for flipping is also crucial for what kind of money you can use, primarily because of labor costs. You can flip houses in Nashville for a considerable profit, even using hard money, but try to do the same thing almost anywhere in Maryland, or the metro Washington, D.C. area with hard money. You're doing excellent to see a $10,000 profit. Commodities. These are raw materials such as oil, gold, and corn. Commodities can be volatile investments, but they can also generate high returns if the prices of the underlying commodities rise. For instance, gold has been trusted by many investors for its wealth preservation qualities. Consider comparing owning $50 worth of gold in 1980 and owning a $50 note. Gold has since gone up in value, so the value of the gold far exceeds the original $50 investment. However, the $50 note has not increased in value, and due to inflation, it cannot be bought as much as it could have in 1980. At the same time, gold prices often appreciate alongside rising inflation rates and a depreciating dollar. For this reason, investors may buy gold as a hedging asset when they realize they are losing money. This follows the general logic that gold often maintains its value or even appreciates when the dollar's value falls. Unlike currencies, gold is not directly impacted by interest rate decisions and cannot be printed to control supply and demand. Gold is a scarce asset that has maintained its value over time and has proven its worth to act as an insurance policy during adverse economic events. Because of this, many investors consider gold a haven. A balanced portfolio will often include diversification assets like gold, as they are commonly negatively correlated to the stock market. Having a diverse investment portfolio helps to reduce risk and volatility for investors. The values of gold stocks are usually partially reflected by the price movements of the precious metal gold. However, gold stocks can maintain profitability even when prices are low. Additionally, many gold mining companies pay substantial dividends, which can help provide further incentives for investors to buy gold stocks instead of gold. Cryptocurrencies. Cryptocurrencies are digital assets that use blockchain technology for secure transactions. They can provide high returns, but involve high volatility and regulatory risks. Because the crypto market is so volatile, you should only invest the cash that you can afford to lose. After learning, you can invest more. For starters, you can stick to top crypto projects. These are less risky. You can see the cryptocurrency index, info, and history chart at CoinMarketCap. Generally, you buy at a low price and sell at a high price. If you're at a loss, never sell it. Selling at a loss is not a good practice. Patience is essential in crypto trading. Each coin will pump again. To be an expert crypto investor, you should be interested in cryptocurrency news and updates. According to Robert Kiyosaki, investing is not risky. Being financially uneducated is risky. Meanwhile, it is good that you bear in mind that the best type of investment asset for you will depend on your circumstances and risk tolerance. Which of these assets have you ever invested in? Let us know your thoughts in the comments section below. Thanks for watching and see you in the next video.